How to invest in 2026. There is a fundamental truth about financial markets that most investors either ignore or fail to understand. It has nothing to do with earnings reports, economic indicators, or even the headlines that dominate cable news. It is far simpler and far more consequential. The Federal Reserve controls the direction of nearly every major asset class on the planet. When the Fed expands the money supply and lowers interest rates, asset prices rise. When the Fed contracts liquidity and raises rates, asset prices fall. This is not theory, this is not speculation. This is how the modern financial system has operated for decades, and it is precisely why the next 18 months represent one of the most significant opportunities for wealth creation in recent memory. Right now, as we enter 2026, the Federal Reserve has signaled a decisive shift. The era of aggressive monetary tightening that defined 2022 and 2023 is over. The central bank is no longer fighting inflation with the same urgency. Instead, it has pivoted towards supporting economic growth, stabilizing the banking system, and ensuring that financial conditions remain accommodative. This pivot has profound implications for stocks, gold, silver, Bitcoin, real estate, and virtually every asset that trades in dollar-denominated markets. Understanding this shift is not optional for serious investors, it is essential. The concept that underpins everything happening in global markets today is liquidity. This term gets thrown around constantly in financial media, but few commentators take the time to explain what it actually means. Liquidity, in its simplest form, refers to the amount of money available in the financial system and how easily that money can move from one place to another. When liquidity is abundant, capital flows freely. Banks lend more aggressively. Corporations refinance debt at lower rates. Investors take on additional risk. Asset prices climb because there is more money chasing the same limited pool of investments. Conversely, when liquidity contracts, the entire system tightens. Credit becomes scarce, lending standards increase, risk appetite evaporates, asset prices decline as capital retreats to safety. Imagine the global financial system as a massive interconnected pool. Liquidity is the water level. When the Federal Reserve pumps more water into the pool, everything floating inside rises higher. When the Fed drains water from the pool, everything sinks. This metaphor may seem overly simplistic, but it captures the essence of what drives market behavior. The Federal Reserve, along with other major central banks, controls the spigot. Their decisions about interest rates and balance sheet policy directly determine how much water flows into the system. And right now, the water level is rising again. This brings us to the question that every investor should be asking. Why is the Federal Reserve easing policy after spending more than 2 years fighting inflation? The answer lies in the structural fragility of the American economy and the sheer magnitude of government debt. The United States federal government currently carries more than $34 trillion in total debt. Interest payments on that debt have become one of the largest line items in the federal budget, exceeding defense spending for the first time in history. When interest rates remain elevated, the cost of servicing this debt becomes unsustainable. The government must either cut spending dramatically, raise taxes significantly, or find ways to reduce the effective interest rate on its obligations. The Federal Reserve, despite its claims of independence, operates within this fiscal reality. Lower rates reduce the government's borrowing costs. Balance sheet expansion provides a ready buyer for Treasury securities that might otherwise struggle to find demand at current prices. The Federal Reserve began signaling its policy shift in late 2024. After keeping the federal funds rate at elevated levels for more than a year, the central bank initiated a series of rate cuts that have continued into 2026. These cuts have been modest by historical standards, but their direction is unmistakable. The Fed is no longer tightening, it is easing. More importantly, the central bank has quietly resumed balance sheet expansion. Officials have been careful to avoid calling this quantitative easing, preferring technical terminology like reserve management and liquidity operations. The distinction is largely semantic. When the Federal Reserve purchases Treasury securities and mortgage-backed securities, it creates new dollars to do so. Those dollars enter the financial system. They increase the money supply. They push asset prices higher. The label attached to this activity matters far less than its economic effect. Beginning in December 2024, the Federal Reserve announced a program to purchase $40 billion in securities per month. This amount may seem modest compared to the trillions deployed during the pandemic, but it represents a meaningful injection of liquidity into a system that had been starved of it for nearly 2 years. Markets responded immediately, stock indices rallied, gold and silver climbed to new highs. Bitcoin surged past previous resistance levels. The correlation between Fed balance sheet expansion and asset price appreciation is not coincidental. It is causal. Every major bull market of the past 15 years has coincided with periods of easy monetary policy. Every major correction has coincided with tightening. This pattern is so consistent that ignoring it borders on negligence. The implications of this policy shift extend far beyond domestic equity markets. When the Federal Reserve cuts interest rates and expands the money supply, the relative attractiveness of the United States dollar diminishes. Foreign investors seeking yield look elsewhere. Domestic savers find that their cash holdings generate less income. Capital flows out of dollar-denominated instruments and into assets that offer better returns or serve as stores of value. This dynamic tends to weaken the dollar against other major currencies. A weaker dollar has cascading effects throughout the global economy. It makes American exports more competitive. It reduces the real burden of dollar-denominated debt held by foreign governments and corporations. It pushes commodity prices higher because most raw materials are priced in dollars. A barrel of oil, an ounce of gold, a bushel of wheat. These goods do not become more valuable in absolute terms when the dollar weakens. They simply require more dollars to purchase. The current administration has made clear that it does not favor a strong dollar. This position makes economic sense given the challenges facing the American economy. A strong dollar attracts foreign capital, but it also makes American goods more expensive on international markets. It squeezes corporate profit margins for companies with significant overseas revenue. It tightens global financial conditions because so much international debt is denominated in dollars. When the dollar strengthens, foreign borrowers must use more of their local currency to service dollar-denominated obligations. This creates stress in emerging markets and can trigger capital flight that destabilizes entire economies. A moderately weaker dollar, by contrast, supports domestic economic activity, eases global financial conditions, and helps the government manage its debt burden. Dollar weakness is not an accident or an unintended consequence of Fed policy. It is, in many ways, the policy itself. This environment is exceptionally favorable for precious metals. Gold has served as a store of value for thousands of years, precisely because it cannot be printed by central banks. When fiat currencies lose purchasing power through inflation or deliberate devaluation, gold retains its ability to store wealth across time. The relationship is mathematical. If the supply of dollars increases while the supply of gold remains relatively constant, the dollar price of gold must rise. This is exactly what has happened throughout history, and it is exactly what is happening now. Gold prices have reached all-time highs as investors recognize that the Federal Reserve has returned to its default mode of monetary expansion. Silver, often called the poor man's gold, tends to outperform its yellow counterpart during periods of rapid monetary expansion because it serves both as a precious metal and an industrial commodity. Increased liquidity supports asset prices broadly, while weaker dollars push commodity prices higher. Silver benefits from both tailwinds simultaneously. The rise of Bitcoin adds a new dimension to this analysis. The cryptocurrency emerged from the ashes of the 2008 financial crisis, explicitly designed as an alternative to fiat money controlled by central banks. Its supply is fixed at 21 million coins, a constraint that cannot be altered by any central authority. This makes Bitcoin appealing during periods of aggressive monetary expansion for the same reasons that gold appeals. When central banks increase the supply of their currencies, assets with fixed supplies become relatively more scarce and thus more valuable. Bitcoin has increasingly behaved like a risk asset, rising when liquidity expands and falling when it contracts. The correlation with Fed policy has become pronounced over the past several years. Each round of quantitative easing has been followed by a Bitcoin bull market. Each period of quantitative tightening has been followed by significant corrections. This pattern suggests that Bitcoin, despite its revolutionary technology and libertarian philosophy, remains tethered to the same liquidity dynamics that govern traditional financial markets. The current cycle appears particularly favorable for cryptocurrency. Institutional adoption has reached unprecedented levels. Major asset managers now offer Bitcoin exchange-traded funds that trade on regulated American exchanges. Corporations hold Bitcoin on their balance sheets as a treasury reserve asset. Payment processors have integrated cryptocurrency into their platforms. This infrastructure did not exist during previous cycles. It means that the next wave of liquidity entering financial markets has a clear pathway into digital assets. Ethereum, the second largest cryptocurrency by market capitalization, benefits from similar dynamics while also serving as the foundation for decentralized finance applications. As liquidity returns to risk assets, capital flows into the entire cryptocurrency ecosystem, lifting prices across the sector. The stock market presents a more nuanced picture. Equity valuations by traditional metrics appear stretched. Price-to-earnings ratios for major indices sit well above historical averages. Corporate profit margins face pressure from higher wages, supply chain adjustments, and geopolitical uncertainty. These fundamentals would normally argue for caution, yet the market continues to climb. The explanation lies in the denominator of valuation ratios. When interest rates fall, the discount rate applied to future cash flows decreases. This makes those future cash flows more valuable in present terms. A company expected to generate steady profits over the next decade is worth more when interest rates are 4% than when they are 6%. The mathematical relationship is direct and unavoidable. Lower rates justify higher valuations. They also make alternative investments like bonds less attractive on a relative basis. Investors seeking returns cannot park their capital in treasury securities yielding 3% when inflation runs above that level. They must accept risk. They must own equities, real estate, commodities, or other assets that offer the potential for appreciation. This dynamic explains why stock markets can continue rising even when economic conditions feel uncertain. The average American may feel squeezed by elevated prices, stagnant wages, and expensive housing. Consumer sentiment surveys may register pessimism, but these indicators do not drive asset prices in the short term. Liquidity drives asset prices. When the Federal Reserve injects money into the financial system, that money must go somewhere. It flows into stocks, bonds, real estate, precious metals, cryptocurrencies, and every other asset class that offers a return. The pools where this capital accumulates are finite. The amount of capital is expanding. Prices rise accordingly. Geopolitical developments reinforce these monetary dynamics. The BRICS alliance, comprising Brazil, Russia, India, China, South Africa, and a growing list of additional members, has accelerated efforts to reduce dependence on the United States dollar for international trade. These nations collectively represent a significant share of global GDP and population. Their efforts to establish alternative payment systems, trade in local currencies, and potentially develop a common reserve currency challenge the dollar's dominance in ways that seemed unthinkable a decade ago. De-dollarization does not happen overnight. The structural advantages of the dollar, including deep liquid markets, the rule of law in American courts, and decades of accumulated trust, provide significant inertia. But the trend is unmistakable. Central banks around the world have increased their gold reserves as a hedge against dollar exposure. Commodity contracts increasingly settle in currencies other than the dollar. Each incremental shift away from dollar dependence adds selling pressure to the currency and buying pressure to alternatives like gold and Bitcoin. The Federal Reserve operates with an implicit understanding that markets cannot be allowed to crash. This understanding, developed over decades of intervention, has created what traders call the Fed put. A put option gives its holder the right to sell an asset at a predetermined price, providing protection against declines. The Fed put is metaphorical, but its effect is real. When markets fall sharply, the Federal Reserve intervenes with rate cuts, liquidity injections, emergency lending facilities, and whatever other tools prove necessary. This pattern has repeated so consistently that investors now treat it as a reliable feature of the financial landscape. In 2008, the Federal Reserve responded to the collapse of Lehman Brothers with unprecedented monetary expansion. In 2020, the Fed responded to pandemic lockdowns with even more aggressive intervention. In 2023, the Fed responded to regional bank failures by creating emergency lending programs that effectively backstop the entire banking system. Each crisis has been met with a larger response. Each response has conditioned markets to expect support during the next crisis. The existence of the Fed put does not mean markets cannot decline. Volatility is inherent to financial markets. Corrections of 10, 15, or even 20% remain possible, and perhaps even likely at some point during the current cycle. What the Fed put means is that sustained crashes, the kind that destroy wealth over extended periods, tend to be met with policy responses that eventually restore prices. Investors who understand this dynamic behave differently than those who do not. They buy dips rather than panic sell. They maintain exposure to risk assets rather than retreating entirely to cash. They recognize that the Federal Reserve, for better or worse, has become the backstop of last resort for global financial markets. Critics argue that this arrangement creates moral hazard, encourages excessive risk-taking, and distorts the allocation of capital throughout the economy. These criticisms have merit. A system where losses are socialized while gains remain privatized creates perverse incentives. But the question for investors is not whether the system should work this way. The question is whether it does work this way, and the evidence overwhelmingly suggests that it does. Central bank intervention has become the defining feature of modern markets. Fighting against this reality, Betting that the Fed will allow markets to crash and stay crashed has been a losing strategy for decades. The phrase itself has become investing wisdom. Do not fight the Fed. Looking ahead to the remainder of 2026, several developments warrant close attention. The Federal Reserve will install new leadership in May. The current chair's term expires, and a new appointee will bring fresh perspectives and priorities. Historical precedent suggests that new Fed chairs tend to favor accommodative policy, particularly when appointed by administrations seeking economic growth heading into elections. The incoming chair will inherit a system heavily dependent on low rates and abundant liquidity. Any attempt to normalize policy aggressively would risk triggering the very crisis that accommodative policy is designed to prevent. The path of least resistance runs through continued easing, continued balance sheet expansion, and continued dollar weakness. The midterm elections in November 2026 add political pressure to maintain favorable economic conditions. Incumbent parties historically suffer when economic indicators deteriorate. The administration has every incentive to ensure that growth continues, employment remains strong, and financial markets remain buoyant. These incentives align with the Federal Reserve's institutional bias toward accommodation. The combination of political pressure, structural debt concerns, and market fragility creates an environment where policy is likely to remain supportive for asset prices throughout the year and potentially beyond. This does not mean investors should abandon caution entirely. Concentration risk remains a concern. Valuations in certain sectors, particularly technology, have reached levels that assume continued perfection in execution and margins. Individual companies can disappoint regardless of macroeconomic conditions. Diversification across asset classes, sectors, and geographies remains prudent. Position sizing should reflect the reality that volatility can spike without warning. Cash reserves provide optionality to take advantage of corrections when they occur. These principles of sound investing do not change simply because the Fed is easing. The opportunity in 2026 lies in recognizing the macro environment and positioning accordingly. This means maintaining meaningful exposure to equities, particularly sectors that benefit from lower rates and economic growth. It means owning precious metals as a hedge against currency debasement and geopolitical uncertainty. It means considering cryptocurrency as part of a diversified portfolio, with appropriate risk management given the asset class's volatility. It means avoiding the temptation to sit entirely in cash, waiting for a crash that may not come or may be quickly reversed by policy intervention if it does. The question many investors ask is whether they have missed the opportunity. Gold has already risen substantially. Bitcoin has recovered from its bear market lows. Stock indices sit near all-time highs. Buying at these levels feels uncomfortable. The fear of buying at the top is natural and understandable. But this fear must be weighed against the alternative. Sitting in cash means accepting certain losses to inflation. The purchasing power of dollars held in savings accounts erodes steadily when consumer prices rise faster than interest rates. This erosion is invisible but relentless. It compounds over time. The investor who waits for a crash that never comes or takes years to materialize may find that their nominal cash balance has lost substantial real value during the waiting period. The more relevant question is not whether prices can go higher, but what would cause them to go lower and stay lower. For asset prices to decline and remain depressed, the Federal Reserve would need to tighten policy aggressively and sustain that tightening in the face of market declines, economic weakness, and political pressure. This scenario remains possible but appears increasingly improbable given the constraints facing policymakers. The debt levels are too high. The economy is too dependent on low rates. The political incentives all point toward continued accommodation. Until these conditions change, the path of least resistance for asset prices remains upward. The lesson of the past 15 years is simple but profound. Liquidity matters more than almost any other factor in determining market direction. When central banks expand the money supply, asset prices rise. When they contract the money supply, asset prices fall. This relationship has held through financial crises, pandemics, trade wars, and political upheaval. It will likely continue to hold as long as central banks retain their current role in the financial system. Investors who understand this relationship and position accordingly have an enormous advantage over those who focus exclusively on traditional fundamentals or short-term headlines. The Federal Reserve has declared its intentions clearly. It is cutting rates, it is expanding its balance sheet, it is providing liquidity to ensure stable financial conditions. Fighting against this tide has historically been futile. The wise investor aligns their portfolio with the direction of policy, maintains discipline through inevitable periods of volatility, and recognizes that the rules of the game, however flawed they may be, remain the rules under which markets operate. The opportunity in 2026 is not to predict the unpredictable, but to understand the predictable. And what is predictable is that the Federal Reserve will continue to support asset prices for as long as the structural conditions that demand such support remain in place. Those conditions show no sign of changing anytime soon. The government's fiscal position requires low rates. The banking system's stability requires abundant liquidity. The political calendar requires favorable economic conditions. Every stakeholder with power over monetary policy has incentives aligned toward continued accommodation. This alignment creates an environment where remaining invested, staying patient through volatility, and adding to positions during corrections represents a rational strategy grounded in how the system actually functions. The alternative, waiting on the sidelines for conditions that may never materialize, carries its own risks. Inflation continues to erode purchasing power. Opportunity costs accumulate as assets appreciate without you. The psychological challenge of buying after prices have risen further becomes even more daunting. The investors who recognize the current moment for what it is, a continuation of multi-decade trends in monetary policy, position themselves to benefit from those trends rather than fighting against them. This is not about optimism or pessimism. It is not about political views or ideological preferences. It is about understanding the mechanics of a system that rewards those who align with its direction and punishes those who bet against it. The message for 2026 is clear. The Federal Reserve is your friend until it becomes your enemy. And right now, the Fed is doing everything in its power to support asset prices. Recognizing this reality, acting on it with prudence and discipline, represents the clearest path forward for investors seeking to protect and grow their wealth in an uncertain world.